Cryptocurrency investments have revolutionized the financial world, offering an exciting mix of innovation and opportunity. On the pro side, they bring decentralization, high growth potential, and a hedge against traditional markets. However, they come with significant cons, including extreme volatility, regulatory uncertainty, and security risks. Today, we will talk about the pros and cons of cryptocurrency investments. So before we start, make sure to hit the like button and subscribe to my channel. The pros and cons of cryptocurrency investments. Cryptocurrency investments have emerged as a dynamic and often polarizing topic in the world of finance, as digital currencies like Bitcoin, Ethereum, and thousands of others have gained traction. They have sparked debates among investors, economists, and policymakers. While they promise revolutionary changes to the way we think about money and transactions, they also bring risks that cannot be ignored. Below, we explore in detail the many advantages and disadvantages of cryptocurrency investments. What are cryptocurrencies? Cryptocurrencies are decentralized digital assets that use blockchain technology to record transactions in a secure, transparent, and immutable ledger. Unlike traditional fiat currencies, cryptocurrencies are not controlled by a central authority, such as a government or financial institution. Instead, they operate on decentralized networks of computers, nodes, making them resistant to censorship and central manipulation. Bitcoin, the first cryptocurrency, was introduced in 2009 as a response to the financial crisis, offering an alternative to traditional banking systems. Since then, the cryptocurrency ecosystem has expanded, including altcoins, alternative coins like Ethereum, Ripple, and Litecoin, and tokens, digital assets used within specific applications. The pros of cryptocurrency investments. High return potential. One of the most compelling reasons people invest in cryptocurrencies is the potential for substantial returns. Bitcoin, for instance, experienced exponential growth, skyrocketing from just a few cents to tens of thousands of dollars per coin within a decade. Similarly, altcoins like Ethereum have delivered significant gains, particularly for early adopters. The rapid appreciation of these assets has attracted investors seeking high-growth opportunities, often outperforming traditional investments like stocks and bonds. Decentralization and autonomy. Cryptocurrencies operate on decentralized networks, which means they are not subject to the control of central banks or governments. This decentralization ensures that individuals have greater control over their assets, free from inflationary policies or arbitrary restrictions. For those in countries with unstable currencies or authoritarian regimes, cryptocurrencies can serve as a financial lifeline. Accessibility and global reach. Unlike traditional financial systems that may exclude unbanked populations, cryptocurrencies are accessible to anyone with an internet connection. This inclusivity has opened up investment opportunities for millions worldwide, democratizing finance in ways traditional institutions have not. Furthermore, cryptocurrencies enable seamless cross-border transactions, often at lower fees and faster speeds than conventional banking systems. Transparency and security. Blockchain technology, the backbone of cryptocurrencies, ensures a high degree of transparency and security. Every transaction is recorded on a public ledger, making fraud or manipulation nearly impossible without controlling the majority of the network's computational power, an extremely difficult task. Additionally, the use of cryptographic techniques safeguards users' data and funds. Diversification of investment portfolio. Cryptocurrencies can serve as an excellent diversification tool for investors. Because their performance often does not correlate directly with traditional asset classes, such as stocks or real estate, they can reduce overall portfolio risk. This diversification can be particularly beneficial during economic downturns or periods of inflation. Potential for financial innovation. Cryptocurrencies have spurred a wave of innovation, particularly in decentralized finance, DeFi. Through DeFi platforms, users can lend, borrow, and earn interest on their digital assets without the need for traditional banks. Similarly, Smart contracts on blockchain networks like Ethereum allow for automated and trustless transactions, paving the way for new business models. The cons of cryptocurrency investments: extreme volatility. Perhaps the most significant downside of cryptocurrencies is their notorious price volatility. While Bitcoin's meteoric rise is well documented, it has also experienced dramatic crashes, losing as much as 80% of its value during bear markets. This volatility can be nerve-wracking for investors, especially those with low risk tolerance or short investment horizons. Lack of regulation. Cryptocurrencies exist in a regulatory gray area in many countries, which can pose significant risks for investors. While this lack of regulation allows for innovation, it also opens the door to scams, fraud, and market manipulation. Regulatory uncertainty, such as government bans or crackdowns, can further destabilize the market, making it a risky endeavor. Security concerns. While blockchain technology is inherently secure, the broader cryptocurrency ecosystem is not immune to hacks and theft. Cryptocurrency exchanges, where users often store their assets, have been targeted in high-profile hacks, resulting in billions of dollars in losses. Furthermore, users who lose their private keys, essentially the password to their digital wallets, may permanently lose access to their funds, as there is no central authority to recover them. Scalability issues. Many cryptocurrencies, including Bitcoin and Ethereum, face scalability challenges that limit the number of transactions they can process per second. This can lead to slower transaction times and higher fees during periods of high demand. While solutions like the Lightning Network and Ethereum 2.0 are in development, these issues remain a barrier to mass adoption. Environmental concerns. The energy-intensive process of mining cryptocurrencies, particularly proof-of-work coins like Bitcoin, has raised significant environmental concerns. Mining requires vast amounts of computational power, often powered by fossil fuels, contributing to carbon emissions. This environmental impact has drawn criticism from policymakers, environmentalists, and even investors. Speculative nature. Cryptocurrencies are often viewed as speculative investments rather than stable stores of value. While some argue that Bitcoin is digital gold, others point out that its price is largely driven by speculation rather than intrinsic value or earnings potential. This speculative nature can result in irrational market behavior and bubbles. Considerations for investors. Do thorough research. Before investing in cryptocurrencies, it is essential to understand the technology, market dynamics, and specific assets you're considering. Resources like white papers, market analyses, and expert opinions can provide valuable insights. Diversify your investments. As with any investment, diversification is key. Allocating a small portion of your portfolio to cryptocurrencies, rather than going all in, can help manage risk while still allowing for exposure to potential rewards. Use reputable platforms. When buying, selling, or storing cryptocurrencies, choose reputable exchanges and wallets with strong security measures. Consider using hardware wallets for long-term storage to reduce the risk of hacks. Stay updated on regulations. Keep an eye on regulatory developments in your country and globally, as they can have a significant impact on the value and legality of your investments. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.